and gentlemen, thank you for joining us today for the New India Assurance Company Limited earnings call for Q1 FY2024. I am Nirav, your moderator for this call. We have with us today Ms. Neerja Kapoor, Chairman and Managing Director, Mr. Titus Francis, Director, GM and Chief Financial Officer, and other members of the executive team. Before we begin, I would like to remind everyone that today's discussion may contain forward-looking statements based on our current expectations. These statements are subject to risk and uncertainties that could cause actual results to differ materially. Please refer to the latest exchange filing for more information on these risks. At this moment, all participants are in listen-only mode. Later, we will conduct a question and answer session. At that time, if you have a question, please press star and 1 on your telephone keypad. Please note that this conference is being recorded. Should you need assistance during this conference call, please signal an operator by pressing star and 0 on your touchtone phone. I would now like to hand the floor over to Ms. Neerja Kapoor. Thank you, and over to you, ma'am.
Thank you. A very good evening to all. Thank you very much for joining us today for the earnings call of the New India Assurance Company Limited, where we will discuss our Q1 financial results for the financial year 23-24. I am Neerja Kapoor, Chairperson and Managing Director, and along with me is Mr. Titus Francis, Director and GM and CFO. Firstly, I would like to thank all the participants who have taken time out for attending this con call. I would also like to express my gratitude to our valued shareholders, analysts, and investors for your continued support and interest in our organization. There has been remarkable growth in the Indian insurance sector over the past few years. However, India still remains under-penetrated with general insurance penetration around 1%. IRDA, the regulator, and Government of India, along with the various insurers, are taking many steps to help increase insurance cover, bring down the cost of premium, and educate people about the importance of insurance. Furthermore, we are witnessing increasing disposable income, increasing cost of medical expenses, alongside awareness and willingness of the new generation to opt for a health cover. All this has helped increase the penetration levels to some extent. We firmly believe that this will only increase substantially with time. I am happy to report that New India is again a market leader with the highest market share in general insurance industry, with an industry market share of 16.16%, with gross domestic direct premium underwritten at rupees 10,378 crore for the first quarter. Coming to the segment-wise growth, motor OD, that's own damage, registered highest growth of 38%, followed by motor third party at about 9%. Health and personal accidents showed a growth of 8%, and others, including miscellaneous lines of policies, registered a growth of 7% and fire at 4%. New India continues to be conservative and guarded when it comes to group mediclaim. Some key ratios which I would like to highlight are as follows. Combined ratio for the quarter was 115.5%. Commission ratio stood at 7.49% as compared to 6.56 in the Q1 of last financial year. Expense ratio reported for the first quarter stands at 11.77% vis-a-vis 12.38 in the corresponding quarter of the last financial year. Solvency ratio improved to 1.85 in the first quarter as compared to 1.72 in the first quarter of last financial year, and ROE stood at 5.26 as compared to 2.58 in the same period last year. Profit after tax more than doubles to 260 crores versus 119 crores for the same quarter last year, registering a growth of 118.5%. Net worth was 41,255 crores, and the investment assets were 90,152 crores as of 30th of June 2023. The overall ICR for the first quarter stood at 96.19 as compared to 94% of the previous corresponding period in the last year. Our focus for the rest of the year is on the following initiatives. Firstly, to focus on the growth of our agency and bancassurance lines. Speedy claim settlement, we will be focusing on improving our turnaround time and ICR, better customer satisfaction, and improving the settlement ratio to 95%, which it has been in all the past years. app-based motor claim settlement for smaller value claims, and also increasing our digital footprint. Various new products have been launched recently. In health, Atmanirbhar policy for the physically challenged. We are also working on introducing various add-on covers in the health policy as well as revisions in our top-up covers. Miscellaneous products as well as property-specific products and add-ons to cater to market demands are in the pipeline. Going forward, our focus will remain on digital initiatives, streamlining processes for increased efficiency, strengthening our sales force. I would also like to convey to our stakeholders that New India is fundamentally robust and strategically well poised to cater to the general insurance needs of the country, offering the best insurance solutions to its customers. With this, I'd like to request our Director, GM and CFO, Mr. Titus, to present the Q1 of this financial year financials.
Good evening to all. Thank you once again for joining the earnings call for the first quarter. We're just going through the investor PPT and the override of New India. So we're giving you the overview of New India. We are the largest general insurance company in India with an established brand, an expansive multi-channel distribution network, and a strong international presence. We are number one in India in terms of net worth, domestic gross direct premium, highest number of offices, as well as maximum number of claims settled. We have almost 1,900 plus offices in India. We are into the 105th year of operation. We have issued 30 million policies in FY2023 across all product segments, and we have a presence in 25 countries, including the Boxer, Lloyd's, London. If we go to the segment-wise performance, we are the market leaders in almost all the major segments. We have a market share of 16.16% as of June, which is highest among all the companies. We are leaders in fire, marine, engineering, motor, health, including PA, aviation, and other miscellaneous. Our future strategy continues to be increasing the return on equity by maintaining or increasing the market share and leveraging the benefits of economies of scale driven by growth, by rationalizing of operating offices, maintaining healthy solvency margin, and increasing our digital penetration, leveraging technology to drive customer satisfaction, profitability, and growth. The business mix of the company, we have fire at 18%, marine at 2%, motor at 22%, health and PE at 49%, and others at 9%. Our distribution mix is direct at 35%, agency 22%, broker 35%, dealer 7%, and bancassurance 1%. The movement in technical reserves as of June is 49,508 crores, which shows that the company is adequately provided for. The financial snapshot shows that in Q1, June 23, we had a PAT of 260 crores against 118 crores in last June. It's almost more than double the profit. And we also had in March 23, 1,055 crores PAT against 164 crores PAT as of March 22, showing that we have turned around and come back to showing good profits. Our key ratios, the incurred claim ratios in Q1 FY24 has slightly increased to 96% from 94.05 last June. Our commission ratio is at 7.49 against 6.56% last June, and our expense ratio is 11.77 against 12.32 last June. Combined ratio is at 115.45. It has come down from 117.15 in March 23. Solvency ratio has also improved from June 22 to 1.85 from 1.72, and our ROE is also improved to 5.26 from 2.52% last June. Coming to the segment-wise information, we have shown accretion in all the segments and already informed by CMD man. Addition is more in motor as well as health line of business, and we are grown in almost all these lines of business except for motor, which is at flat percent. And ICR also, there has been a slight increase in the ICR in motor, TP as well as health. Overall, a 2%, almost 2% increase in ICR. And that's the brief of New India's performance for June 23. Thank you very much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sanket Goda from Avendus Spark. Please go ahead.
Thank you for the opportunity, sir. Sir, my question is largely with respect to one with respect to the loss ratios. Just wanted to understand, though the motor OD has grown year on year for us, but the loss ratios more than 100 is meaningfully very high. And so just wanted to understand chasing growth in such an environment where loss ratios are very high is logically right, or you think this thing will improve as the time will progress? That's on motor OD. On TP, just wanted to understand, suddenly you have sharply improved the loss ratio, increased the loss ratio from 84 to 95. Is it largely because you don't have a price hike and wage inflation, the wage inflation or claim inflation is biting us, and that's the reason you have provided more in the quarter one, leading to the higher motor TP loss ratio? And lastly, you can throw a little more light on the health also. We believe what we have heard is that the group health pricing has improved only. Despite price improvement for the industry as a whole, you are seeing a higher loss ratio compared to the last year. So if you can explain about these three products, why the loss ratios are relatively higher, it will be useful, and how you look it to happen going ahead.
Yeah, thank you for the question. Neeta here. I will answer all the three. Regarding motor OD, yes, the claim ratio has, been, it's above 100. But if you see compared to the quarter one of last year, vis-a-vis the quarter one of this year, there's a substantial reduction of 4 points from 116 to 112. We are taking a lot of steps in, correcting these, the ICR going forward. But we have to understand that there has to be a balance between growth as well as the loss ratios. For a long time, for nearly 3 to 4 years, our motor portfolio has not, we have not been able to grow substantially in that particular segment. But we, with the steps that we have taken with our, constant endeavors to improve our footprint here, we have been able to show some increase, good increase in the motor segment. And we believe that this would, give better results going forward. A lot of steps are being taken to reduce the ICR in motor OD, particularly price corrections. And we now have a very dynamic tool for price corrections based on the, the cluster where the claim ratios are higher. We will be taking corrective action there. And this is a dynamic process which will be addressed on, on a daily, weekly, and a fortnightly basis. We are also looking at balancing our portfolio mix so that we have more of profitable segments which are underwritten. And yes, this takes a little time because the policies are issued for, annually for a year. So if any correction is done, it takes about 3 to 4 months for that correction to actually result in results which can be seen. We are looking to underwrite more two-wheelers, which is relatively a profitable segment. And we've also introduced AI-based claims assessment, which will help to increase the turnaround time for the claim settlement and also will address ICR issues and help to reduce ICR because the claims will be settled much faster and in a much better way. Regarding the motor TP, the query on motor TP, yes, the price not having increased does impact this particular segment, and we are seeing that after the COVID case, the pandemic period has been over, the courts are now fully functional, and we are seeing a slight uptick in the interest rates which are being given in the awards. Because of the inflationary trends which are there in the country. So yes, we are seeing an increase there, but we are again trying to increase our third-party premium, and especially in the four-wheeler private car, when you get the third-party premium, it's for 3 years, and for two-wheeler policies, it's for 5 years. So we are increasing our footprint in the OEM segment, in the dealer segment, where you get new vehicle policies. Third question was?
Sir, ma'am, just before getting to that health part, means you're saying that you will probably gain market share in two-wheelers and private cars and get to the 5-year and 3-year policies, which means that with the change in expense of management rules, are we seeing a trend that you are able to penetrate more better into dealer channel or OEM channel compared to what it was in the past, ma'am?
Yes, there has been an improvement in our dealer channel. We have seen an increase. One second. Yeah, the dealer segment, we have seen an increase from 41%. It has gone up to about 47%, and the retail channel also proportionately there's a change.
Got it, ma'am. And my last question, the first question was on health. See, last year it was almost 100% loss ratio. It is now 105. And what we believe is that group health has seen a better pricing trend for the industry as a whole compared to what it was last year. So despite that, there is a deterioration. Just wanted to understand what it is. And lastly, given you have delivered almost a combined of 115 in the current year, current quarter, sorry. Do we expect it to improve by what percentage, or what is your guidance for the full year to combine to be maintained, ma'am?
Yeah, so in health line of business, we will definitely see an improvement in the days to come, in the quarters to come, months to come, as well as the quarters to come, because our retail pricing, which we have increased after a period of nearly 6 years of static pricing, that has kicked in from 1st of April for new policies, and for renewals it will be kicking in from the 1st of July. So definitely that impact of improvement in the retail pricing is going to have a very positive impact in the coming months, and we overall expect the ratio, ICR ratio, to improve. Coming to the combined ratio, of course, this is a very forward, making a statement in a dynamic market becomes extremely difficult. But we are looking at improving our combined ratio. That's the target for this year. Overall, we would be looking at reducing the combined ratio.
Ma'am, what is our weighted average price hike in both renewal and new business what we are taking in retail health?
It ranges from different age segments. Average price increase would range between 25 to 30%.
Average, both for new and renewal, ma'am, right?
Yes.
Okay. And finally, on some data keeping questions. Sir, if you can break down your loss ratio of domestic and overseas, and similarly combined ratio domestic and overseas. And finally, if you can give me the quantum of capital gains booked in the current quarter.
Finally, what was the final question you said?
The capital gains booked in the current quarter, ma'am.
Capital gains booked. If you can just answer, meanwhile I'll just open that board.
Yes, Sanket, the capital gains booked in the current quarter is 753 crores.
Okay. Okay. And sir, can you give the breakup of loss ratio broken down into foreign and domestic and similarly combined ratio, sir?
Yeah, just a minute.
Shall I get?
Yeah.
Yeah. The Indian was 115 and the foreign was 116 combined ratio.
Loss ratio, ma'am?
Loss ratio for the first quarter, right? For the
first.
Yeah, the foreign is 85 and Indian was 97.
And 97. Okay, perfect, ma'am. Thank you. That's it from my side. Yeah.
Right.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Amit from Robo Capital. Please go ahead.
Hello, am I audible?
Yeah.
Okay, great. First of all, I appreciate the opportunity. Thank you. I have two questions. My first question is on the ROE. In our stated strategy or goal is to improve ROE, and so just wanted to understand what are the top 2-3 factors that we are banking on to improve ROE, and subset of that is like do we expect combined ratio? Do we have internal targets to have a combined ratio below 110? In next say 2-3 years.
Yeah. Yeah, the ROE will basically depend on the ICR as well as the combined ratio. So we are targeting to bring down the combined ratio, and as of now it is 115. So by the year end we have to bring it down to, at least to 110 around to achieve to increase the ROE. So this is what we will be aiming at. Of course, being, as Madam said, being a dynamic market, we'll have to see how it goes along the way. But our endeavor is to bring down the combined ratio.
Correct. And in terms of ICR, in terms of, because we have already increased prices on some of the portfolios, so how much is, considering the market share, what is the pricing power that we enjoy? Typically a 20-25% increase that we have done on some of the portfolio, will that lead to far better ICR?
See, the overall increase is, in some segments, yes, you're seeing an uptake of about 20-25%, but in other segments it is lesser. So overall we expect to see an increase in the range of 10 to 12%, and yes, definitely there would be an improvement in the ICR because we are focusing on the segments which are, which we are of the view will improve our bottom line, and we are still in the process of letting go or shedding of such accounts or such renewals which are impacting the bottom line repeatedly over many years.
Got it. And if I can squeeze in one more, just wanted to understand what is the unrealized capital gains as on today, or as at the quarter end?
It's around 20,000 crores.
Right. So if for that, say typically when we look at some of the private sector players, okay, they have far significantly lower unrealized capital gains. So is there a what is the internal thought process on this? I mean, why are we? Because significant amount of that essentially has not flown through P&L, whereas we see private sector where unrealized is significantly lower. So any thoughts on that currently and going forward?
Unrealized gain have been built up over a number of years in our case. Private sectors, they have a lower number of years. So we have huge legacy investments, and this is built up over a large number of years. So we cannot realize it in one particular year so much. So we, as of the market progresses, we have keep on churning the portfolio. So that's why, because of the large volumes and large number of years we are in operation, our unrealized gains are higher than the private one.
Right, sir, but of the 20,000 crores, most of it will be listed, right? Significant large, I mean...
Listed. This is a listed one. Most of them are listed.
Right. Okay. Thank you. That's it from my end. Thanks a lot.
Thank you. Participants, you may press star and one to ask the question. Next question is from the line of Kiran Naik from Kiran Investments. Please go ahead.
Thank you for giving me an opportunity, sir. I would like to ask, ma'am, whether the premiums we charge on all the segments are equivalent, are same as the private ones, or we are more premiumized, we charge more than the private players?
I'm not able to understand the question. Are you saying
Premium rate.
the premium rate?
Yeah, premium rates.
Premium rates, see, we are in a competitive market. Obviously, the rates are going to be on similar lines, and in some segments we would be competitive than another insurer, and another segment they could be more competitive. But by and large, the market it's a function of demand and supply. So yes, the pricing would be quite similar in most of the.
How much is our market share in the general insurance sector?
Last year it was 13.42. As in the end of the first quarter, it is 16.16%.
Okay. Thank you, ma'am. Thank you. No more questions.
Thank you. Participants, you may press star and one to ask the question. Next question is from the line of Shubham from Nuvama Wealth. Please go ahead.
Hello. I hope I am audible to her.
Yes.
Yes.
Yeah, thanks for this opportunity to ask the question. So I have two questions. One, what is your corporate and retail sector breakup in your policies? And second one is, you mentioned that you're taking or you're focusing more on your digital initiatives. So just wanted to get a sense like how are we planning this, and where do we see these digital initiatives are helping us in the years to come?
Yeah.
So, what would be the increase in the policy sales that we expect in the years?
We have been, the first question was regarding how much is the share of the corporate business. Total share would be in the range of 38 to 40% of our total business. Retail would be in the range of 60-62%. It varies from time to time, but approximately in the same ratios. We are taking a lot of digital initiatives, and we are, like I mentioned, we are deploying artificial intelligence for doing motor OD claim surveys up to 50,000. This is currently in the pilot phase, and it will be rolled out to all our offices within a month's time once the pilot phase is over. Then we are also having analytics-enabled pricing. We have an Oracle analytics-enabled tool which has been introduced for actuary-driven pricing for the motor OD pricing, which I mentioned earlier is in a dynamic stage, and we will be utilizing this tool going forward for working out the pricing in different segments. We also have an analytics-enabled MIS tool, which for both agency verticals as well as motor OD claims, and which helps us, to analyze on a real-time basis all the data that we have. And we are integrating going forward. We are, integrating with ONDC, and we are planning to commence insurance products on ONDC also. We are in a very active discussion with them to onboard our retail products. We have recently relaunched our website, and it's a very revamped website, and it's linked to chatbot. It is capable of doing natural language processing. Similar various initiatives like network augmentation and also aligning with government initiatives for Jan Suraksha portal integration that has been completed in UAT. And we are also aligning through IRDA and with all the other general insurers for the sandbox integration with NH exchange. Many such other measures are in place where we expect the overall policy increase, our digital footprint to increase by at least 10 to 15% annually.
Thanks for that. That's it from my side.
Thank you. Next question is from the line of Hiren Trivedi, individual investor. Please go ahead.
Yeah. Am I audible? Yeah.
Yeah.
Yeah. Yeah. So my first question is regarding the wage revision that was has taken place earlier and the new wage structure for the employees. So how much of that has been already covered, and how is it going to impact overall going forward in the next 1 or 2 years?
Yes, our wage revision was, which we had, which was implemented last year. Total outgo, including the increase in wages as well as the arrears which we had to pay from August 17 onwards, along with the pension liabilities that we have for our retired employees. That was a total outgo of about 3,445 crores, and that was fully absorbed in last year. So we have not done any amortization. We took the entire hit of the wage revision in the last full year. Nothing has been carried forward for the subsequent years. And we have also made provision in our balance sheet last year itself for any increase in wages in the coming years.
Okay. Yeah. My second question is regarding this. Government is still holding around 85.4%. And so any developments with regards to any offer for sale in the near future to comply with the listing norms to bring it down to maybe 75%?
That is a question we'll have to ask Government of India, and it's something for them to answer. But as of now, there is nothing in the immediate future. Maybe in going forward there would be, depending upon further discussions with them. And regarding your first question also, I would like to add, I think I did not mention that we had earlier when we, about I think 5 years back, we had the one-time pension option. So that time it was amortized over a period of 5 years, and we have an amount of 401 crores which was amortized every year. So this year that 401 crores will be the last year it will be impacting our books. Going forward there will be no more amortization.
Okay. Thank you.
Well.
Thank you. Next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, thank you for the opportunity. Just one question from my side. Could you please touch upon the recent floods in the North Indian region? Do we see any significant losses from that? Quantify this time? Thank you.
Yes, there have been heavy rains and inundation in northern region. And we did have in the first quarter, actually we did have impact of cyclone Biparjoy also in Gujarat. But we have found in the claims that were reported to us in cyclone Biparjoy, initially the claim amounts are quite huge, but then subsequently when the claim settlements are done, it is substantially lesser. In the northern India also, there are claims which have been reported, and we will be getting a better picture in the days to come. But we have to understand that every year there is losses due to floods. We have been seeing catastrophic losses due to floods in the last many years, practically every year. And we have a reinsurance cover for catastrophic claims, so we do not see it majorly impacting our books.
Okay. Thank you.
Rishikesh, sorry, but we are losing your audio.
No, done. Thank you.
Thank you. A reminder to all the participants, remember press star and 1 to ask the question. Next question is from the line of Sriram R. Individual investor, please go ahead.
Thank you for the opportunity. I just have one question. Can you break up your health segment into group and retail in terms of revenue share?
In terms of?
Revenue share of revenue.
Yeah, for the first quarter, we have a total premium of about 5,300 crores, out of which retail is about 600 crores, the government business is about 700 crores, and the group Mediclaim policies are about 4,000 crores.
And for the full year FY23?
Full year FY23, it would be in a similar proportion. I can give you that breakup. Just a minute. Yeah, full year, it did about 16,682 crores, out of which I have the exact figures. Group was 11,688. Government premium was about 2,240, and the retail premium was 2,754 crores.
Okay. That answers my question. Thank you so much.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. Ladies and gentlemen, you may press star and 1 to ask the question. Anyone who wishes to ask a question may press star and 1. Thank you all for being a part of the conference call. If you need any further information or clarification, please email francis.titus@newindia.com.in. Ladies and gentlemen, this concludes your conference today. You may now disconnect your lines. Thank you and have a pleasant day.